Welcome to New York Bio's Virtual Breakfast Series, a digital program started in 2020, bringing you fireside chats with leaders across the healthcare spectrum. This week's episode features David P. Luci, co-founder, president, and CEO of Acurx Pharmaceuticals, and Jeffrey Schultz, a corporate and securities lawyer with Mintz.
Good morning, everyone. My name is Jennifer Hawks Bland, and I'm the CEO at New York Bio. We're very excited that you're here with us for another edition of our virtual breakfast series. Special thanks to the law firm Mintz for sponsoring this month's series of breakfast. Today, we're joined by two guests, and no Derek, as you can see. He's on vacation, so we wish him, hopefully he's on the beach somewhere, but we will carry on. We are excited to have David Luci from Acurx Pharma and Jeff Schultz from Mintz to join us today. So today we're going to talk about deal flow, IPOs, antibiotic companies, and probably a little bit around the market in New York and what the historical market has been in New York. So we have a lot of topics to cover, so we'll definitely get started. Jeff, let me kick it over to you first. To tell us a little bit sort of about your origin story. And you've worked with many companies over a whole variety of scenarios as counsel. So talk to us about how you ended up sort of where you are today and what that path looks like.
Thanks, Jen. So I started out about 23, 24 years ago, kind of during the tech boom. Was involved in a lot of technology companies, did a lot of work with emerging growth companies, venture capital, then moved over to where I'm at currently, Mintz 11, in around 2000, actually. Mintz was a kind of a growing technology firm, had a lot of life sciences work, and that has really exploded over the years since I've been here. And so my practice has really evolved mostly to public companies, taking companies public, representing public companies, doing transactions, capital markets transactions, a lot of experience with SPACs in both or the many waves that have occurred during my career, including the most recent, and generally just doing a lot of representing companies, investors, investment banks. So I really have had good experience with all different sides of transactions and the interests of each parties involved. And so when I do, no matter who I'm representing in a transaction, I know what the other side is thinking. I know what the bankers, where their incentives are.
Yeah.
I know what the investors are looking for. I think it's helped my career in representing companies, especially because I know what everyone else is thinking in the various transactions, which is very important.
Great, thank you. And we'll come back to that. Well, I'm going to poke into some of those things. And then David, talk to us about not only Acurx, but also sort of your path. You've had a storied career in company creation and company selling. So let us have the benefit of your history.
Yeah, sure. So Acurx Pharmaceuticals IPO'd in the middle of 21 with our trusted partners at Mintz 11, who we're deeply appreciative of. And we did a secondary or a registered direct in the middle of 22 as well. We're developing a new class of antibiotics, which if approved would be the first new class since 1980. So it's an important thing. It's not just a derivative of an existing class of antibiotics. It's a new class. And we could talk about why that's important. But our lead drug is looking to treat patients with C. difficile infection, usually called C. diff. And it's very common. It's 500,000 patients per year in the US alone, with about 29,000 deaths per year, $1.7 billion market with a very vulnerable lead antibiotic therapy called oral vancomycin, which is vulnerable for a number of reasons we can discuss. But we think because the market's so large and the frontline treatment is so vulnerable, so weak, that's why folks like Pfizer and Sanofi have attempted to get vaccines approved to treat frontline C. difficile over the past 5 years or so. Both have failed. So we are looking at our data and thinking that we would be frontline therapy if our data continues consistently with the data we've generated so far. In my career, I've co-founded a number of companies. I got into biotech after a 3-year career at Ernst & Young in the healthcare practice group and an 8-year career at Paul Hastings, New York, as an M&A and corporate securities lawyer. Did a lot of IPOs, buying a lot of companies, sold a lot of companies. I joined a company that had no employees, no offices, no checkbook, no nothing. In 2002, it was called BioEnvision. And we built it. I built it into a 65-person company on 3 continents. I in-licensed Asian rights, out-licensed to Hospira the Australian rights. Net, at the end of the day, we got a childhood leukemia drug approved for salvage therapy kids with leukemia. And 1/3 of the kids, after our drug was approved, 1/3 of the kids no longer had leukemia. They live a normal life. And these are kids that were told they had 7 weeks to live. And their parents were told, palliative care, just keep them comfortable. And they'll be gone on average in 7 weeks. So that's where I got the bug, because, I thought that, if we can kind of leave the world a better place than where we found it, it would be a lot more satisfying to me professionally than, whatever else, buying and selling, skyscrapers in Midtown and stuff like that. So,
Yeah,
so
I agree.
yeah, after that, I just kept doing it. We just kept starting our own companies, selling them, starting them, selling them. And I've been doing it ever since. And, we've done a number of IPOs, a number of secondaries, raised probably about $220 million so far. And the sale prices are way, way, way north of that for the companies we've sold. And now, we're doing it with Acurx.
So let's take a step back here, because you both have really deep sort of M&A experience. From both of your perspectives, talk to us about the difference, sort of what the M&A market looks like today, and let's say 5 years ago, right? So let's kind of compare and contrast a couple of timeframes. And I recognize everything, it moves in a cycle. So hopefully, I think I've picked an up cycle and maybe a down cycle, or vice versa. Jeff, talk to us first about sort of what types of deals, how deals are different today from your perspective and your client's perspective.
Yeah, well, the market is really challenging, primarily because no one really knows what valuation should be right now, because we're in a frothy market for a few years there, where valuations were sky high, just kept on increasing, and there's just so much money flowing. Now we're kind of the exact opposite of that, where money is tight, interest rates are a lot higher, obviously, and investors are wary of putting in money at valuations anything close to where they were before. So we're seeing a very difficult dance between investors and companies, and the companies still need money, right? So that hasn't changed to develop their products. But where is that money coming from, and in what structures? And so you need to be more creative. It's not as simple as we're raising money at a higher valuation than our last round. You got to be a little more look in the mirror and just this is what the market is. Down round investments are something that are very present today. So you're going to have to deal with that. Take your medicine. Maybe take less money than you would need to really fully complete your trial, but you want to continue to weather the storm through these tough times, where money is tight. Be creative. There are maybe instead of equity investments, there are partnerships, collaborations, where you get some upfront money, structure it in a certain way where the upside can be captured by the big pharma, the investor. So there's really a lot of things to think about. Whereas back a few years ago, money was just flowing. You could do a deal after deal.
Right.
If you needed money, you could get it. And so things have obviously changed dramatically.
And David, let's shift just slightly. What you've raised money, obviously, as private companies, you've built companies from the ground up, you have IPO'd and you've accessed the public markets for capital. What's different now about raising money as a public company versus like your earlier private rounds?
Versus my earlier private rounds. Earlier private rounds are generally structured around people or who know you that you have access to. So it becomes more of a challenge. On all of my private rounds, I did not use any investment bank. I raised the money myself with my partner, our chairman. So it's more difficult in a private company in volatile times. It's more difficult to raise money. You could argue at any time it's more difficult to raise money. Being a public company has never been more regulated or more difficult. Even the NASDAQ initial listing requirements are now changed, and they've gotten more stringent on the amount of cash you have to have. So you have to do a bigger deal. So but once you get public, then you can use your shares as currency. It's easier to raise capital, and you just have a lot more to manage. You have to manage investor relations. You have to manage your trading volume to try to make sure that you have maximum access to capital and don't run into a problem with somebody that wants to put a lot of money into the company, but sees it may be difficult to get that money out if there's no trading volume. So it's a different set of issues. I like being public because it gives shareholders that were in early the ability to get out when they want, and it gives us the ability to raise money easier and to be recognized by big pharma. There are big pharma companies tracking us now, they tell us. So it's good, but you do get into some tricky situations where if you're trading lower per share than your IPO price, you get some opportunistic kind of mid-level pharma companies like we have that kind of want to use to Jeff's point, your deeply beaten down price as an opportunity to buy your company cheaply.
Yeah, and I would assume, I admit I didn't look up what you IPO'd at, but I would assume, just given the nature of the markets, if your company IPO'd last summer, that you're trading below what your IPO was.
Yeah, we had a kind of difficult IPO. We were well oversubscribed, but there was a lot of volume, a lot of share turnover in the first 7 days after the IPO. You may recall there were turbulent times. I don't think we would have gotten out even a week after we IPO'd. But we got out at $6 a share, trading in the low threes right now. If you look at a chart of other pre-revenue clinical stage companies on the NASDAQ, it's actually much less of a beating than most have taken, which is, totally strange, but,
You'll
in a world, yeah, when up is down, down is up, and the sun rises in the west,
yeah,
we're just glad to have gotten to where we are, because the alternative would be that we're a private antibiotics company, and when the time comes, you need money, in these kinds of times, God knows when they're going to end. You see Jamie Dimon's point from a day or two ago.
Yeah.
You don't want to be that company.
Yeah. No one does. And Jeff, talk to us about, because obviously in the New York ecosystem, we have lots of, not only pre-public, but even preclinical companies. And how should they be thinking about, their sort of runway? Obviously, I know it's highly specific and dependent on, what your asset is and what you have, committed and tranched and raised. but talk to us about how they should be thinking about sort of the runway over the next, I guess normally I would say 2 years, but let's shorten it. Let's say 8 months.
Yeah, so I think all companies with runways, need to really consider belt tightening.
Yeah.
Money is going to be hard to come by, and so you got to be creative. Yeah, and find, if you really, if you didn't prepare for this ahead of time, which a lot of companies don't, and that's kind of a lesson there. Like, take the money when you can, because you don't know what tomorrow's going to bring, and you want to at least, don't worry about, you just want to get to the next milestone, be able to complete your clinical trial, and hopefully it's a success. And some companies are worried about, the valuation isn't right. There's too much dilution. Get the money in. Get the money in. Develop your drug. Don't worry about the short-term gyrations in the stock price. And so that's kind of a lesson, now in hindsight. But for companies right now, you have some belt tightening. Find alternative ways to raise capital. There are, whether it's through partnerships, collaborations, grants, where the equity markets are mostly shut, but there's still ways to, now that valuations come down, there are still opportunities, and investors are putting in money where there are good opportunities. But I think you really got to be creative. And there are, for some companies who want to be public, there are certain types of transactions like fallen angel reverse mergers, which kind of were, kind of much more prevalent maybe 4 or 5, 6 years ago. We see that coming back, where a company's clinical trial maybe has not done so well, and they're looking for another development program. And so for the private company can merge into a reverse merger into a existing public company. We're seeing some more of that. And so you got to be creative. You got to do belt tightening. You got to try to weather the storm until market conditions improve.
Yeah, the only thing I'd add on to that, within the antibiotic spectrum, especially if your asset is a preclinical antibiotic asset and not even in the clinic yet, and you do a reverse merger public shell deal, we made 3 offers to do something like that before our IPO. They're way more dilutive than an IPO, number one. Number two, on the other side of that deal, you got to immediately go out and raise money. It may even be on the same day that you close the reverse merger public shell deal. You got to have an asset that you can finance. And if you're now in a public vehicle, your burn rate just went up, good solid $1 million a year. So
right.
Now,
just from the regulatory requirements, right?
Yeah, don't underestimate the burdens of being public. It's
you're looking at, I mean, D&O insurance for 1 year for a small company being $500,000 fee is not, I mean, it could be a lot even more than that. It could be the whole million of the million I'm talking about. But then you got lawyers and auditors, and you got to pay your board members, and you got to have an IR firm, and there's all these things that you don't need when you're private. So you just got to make sure you have a fundable, financeable asset on the back end of that deal.
That's right.
And probably one takeaway is, especially if you're earlier stage, is really start having those conversations with your board and with your outside advisors or as early as possible, right? So that everyone is on the same page when planning ahead as sort of the, where they want the company to go. David, talk to us a little bit. I'm going to shift gears just a little bit. Let's talk a little bit about sort of developing an antibiotic in today's market. And then I want us to get into, some potential M&A discussions, because I know you recently, at least I think you recently announced that you had added clinical trial sites, right? Just because of the enrollment. So talk to us about the process of doing a phase 2B and then realizing that you needed to either speed up enrollment by, adding sites, or what your thought process was there.
Yeah, so obviously you have a G&A runway which includes everything other than the cost of the trial. And, you want that trial to end as soon as humanly possible, without sacrificing on quality, of course, so that you can minimize the overall cost the company has to bear while it's going through and completing the trial. So, as we continued down the pathway and we saw that enrollment in COVID was not matching enrollment the way we in Syneos Health, our CRO, had experienced prior to COVID, we decided we had to take a bold step. And that's why we raised some money in the middle of the year 2022, so that we could add a whole lot more trial sites and speed up the pace. Fortunately for us, as an aside, our clinical data has been wonderful. But in terms of the enrollment pace, for us specifically, and, I can't generalize with others, but with us specifically, you're looking at a situation where most of the patients with C. diff happen to be 65 or older. And that's the group of people who have been, conditioned by the CDC and all of the mainstream media that their risk of death or severe illness is much greater than somebody younger than 65. So if they're being offered, a small amount of money, $100 a visit, something like that, for 6 visits over 7 weeks, or you can just do a telemedicine interview with your doctor, who can then call in an oral vancomycin script to your local Walgreens on the corner, and you're done. So we're competing with telemedicine. We're competing with staff shortages related to, terminations for those who don't want to get vaccinated. So it's a different world. So we're trying to manage and navigate our way through that. And part of that is, you continue to evaluate the data and see if maybe you don't need to do so many patients. If the data is looking good, there's an opportunity potentially to wrap it up sooner than later and make up some of the time.
And how have you, go ahead, Jeff.
Yeah, I want to add to something David said, and we're seeing that with a lot of our clients, the COVID problems to enrollment for clinical trials. I almost can't count the number of companies that have experienced those issues, and so enrollment has slowed. Their clinical trials, are not, maybe their data is going to be pushed back because the enrollment is not as fast as it was before. And so you're also seeing some companies, change their, number of patients and still change their statistical plan, so that it's still statistically significant, but have less patients if the FDA approves of those changes. So we're seeing a lot of that, and the disclosure in a lot of our clients, you can see that about slowing enrollment, having to figure out ways to cut costs, right? Because it's harder to get enrollment. You need more sites. You got to pay more money. So again, that kind of goes together with belt tightening and being creative, and maybe with your existing clinical trials, and maybe there's a way to get the same type of results, but with less funds, smaller trials. So another way to be creative in belt tightening in this current environment.
Yeah, to Jeff's point, so GSK recently, in the past couple of weeks, announced that they were in licensing worldwide rights to Spiro Therapeutics lead program for urinary tract infections. And in that, as part of that deal, there was $66 million up front, milestones, royalties, but they put $9 million into the company, and Spiro is continuing to run the current trial, and it's a phase 3. If that trial works out, they turn everything over to GSK, and GSK goes and files for approval. So it's another example of a structured transaction. But Jennifer, to your original question, what is it like being in an antibiotics company? For those who consider investing in antibiotics companies, the past 5 years, we've seen a lot of failures, and what I would say is the first kind of node to look at is the difference between if the company has an antibiotic that treats or is attempting to treat gram-negative infections or gram-positive infections. So if you look at the bioindustry guides, antibiotics for infectious disease, there's a percentage likelihood of FDA approval. When you look at infectious disease for antibiotics, it's actually a much worse chance of approval for those developing gram-negative targets than gram-positive. So that's, we're gram-positive, not gram-negative. The second thing, and probably more critical, is the government through the GAIN Act adopted the Qualified Infectious Disease Product Designation rules, which if you're designated a QIDP, you get all kinds of goodies and perks, including 5 years of marketing exclusivity. And then there's this fast track designation. Now for QIDP, you have to treat a serious or life-threatening infection. So if you're an antibiotic that treats something minor, or if it's an infection that's not life-threatening or serious, you fall outside of GAIN. There's new legislation called the Pasteur Act, which follows the same logic, it pulls the same string. So antibiotics companies that qualify as treating a serious or life-threatening infection, they get it's a lot different of a business model than if you don't have that.
So by virtue of incentivizing antibiotic development, did they de-incentivize something that's still needed though in the field of antibiotics? Or do you think that that's the right balance they struck?
No, I think that's the right balance, because as a matter of public policy, you want to do whatever you can. There's a dearth of new antibiotics that have come out. So we all need new antibiotics, but most importantly, we need new antibiotics for things that are killing people. You know what I mean? So they're trying to incentivize that. Scott Gottlieb, the former FDA chief, has been promoting, instead of these push incentives, something called pull incentives that are now approved in the United Kingdom, which is, a sponsor of a new class of antibiotics that treats a life-threatening infection, gets on day one of the marketing period, you get a check from the government for the pharmacoeconomic value as deemed by the government of your antibiotic over a 10-year marketing period. And that's basically what is codified in Pasteur, which the Antimicrobial Working Group in Bio think has a good chance to be passed before the end of the year when Congress turns over.
Yeah. No, and we obviously have had a lot of conversations. We spent a lot of time at New York Bio working on public policy issues, both in Albany as well as, at Washington, although we are really focused on Congress, not on the, the regulatory side. And so it's really important that I'll pitch my bias here. It's really important that those involved on the ground in research and development, developing therapeutics for patients, have their voices heard, right? So it's important that I know you're busy running your day-to-day company, Jeff, you're really busy helping companies grow and expand, but we can't forget that at the end of the day, you have to have a regulatory pathway to reimbursement, payment, access for patients. And if you don't, then we're not going to get very far in the long run.
Yeah, one of the nice things for antibiotics companies that qualify under the Pasteur Act, it would answer for us if we're a critical need antimicrobial under the Pasteur Act. It answers the question that I'm going to be asked as soon as we come out with favorable phase 2B data, knock wood. People are then going to ask, okay, well, how are you going to pay for phase 3? And then I want to hold up a letter from HHS saying, congratulations, Acurx Pharmaceuticals, you have been approved as a newly designated critical need antimicrobial. As such, we will reimburse you for phase 3 costs, manufacturing costs for phase 3, along with pay you, $750 million to $3 billion, depending on the pharmacoeconomic buildup over a 10-year period.
And thinking ahead, thinking of something you said a few minutes ago about sort of, you said GSK, right, had in-licensed and done a structured deal. So I want to talk a little bit more about those types of financings, right, and those types of deals. Jeff, let's start with you. Talk to us about what you're seeing within sort of the broader pharma market as it relates to, earlier stage clinical and preclinical companies now?
Yeah, so it kind of goes back to, figuring out valuations and, what the big pharma, actually the big pharmas are seeing bargains right now. So, a lot of companies who maybe had inflated valuations, a year or two ago, they've come way down. And so promising technologies can be seen on sale. And so we're starting to see some more of it lately, where the big pharmas are acquiring companies or rights to certain drugs. And I think we're going to see a lot more of it as prices continue to be kind of beaten down, and some of these companies are unfortunately become desperate for funding, and so the money's sort of dwindling. The options of raising money are dwindling, and so I think you're going to see, and we're starting to see already, more acquisitions of some of these companies by big pharma. They're going to come in and rescue these companies, or and also take advantage of their positions in the market. We're also and from the other side, from companies who are looking for funding to get to the next milestone. One way to you look in other markets, you can license your rights in a different geographic region, get some money in the door to kind of keep the development process going, and you've given away some rights in another area. So we're seeing some of that. You kind of look outside the box, ways to, and you give upside, your royalties, whatever, you maybe give some upside away for the future if things go well, but you're getting some money in the door now to get to the next stage. And so that's, I think, what a lot of companies in the early stage, with the valuations being down, hard to get money, that's the way they need to be thinking. We need to keep going, get to the next milestone, get to good data, and then we can live to fight another day when hopefully market conditions have improved.
Jeff's spot on, as he's been all morning. But one thing that I've seen that I'd like to add on to that, some of these early stage entrepreneurs, in healthcare, they I would just warn folks, throw everything you can against the wall. All the different things Jeff's talking about. Like, don't do it sequentially. Like, try to get a Japan deal or a China deal to bring money in to help keep the thing, the chains moving with what your primary business plan is. You got to do it all at the same time. You got to go for your IPO, go for a private placement, consider a territorial licensing deal. You just got to keep pushing and pushing and pushing, and not do it sequentially. That'd be my only thing. I've seen too many early stage entrepreneurs take 10 years to get where they could have been in 2 years if they just did everything at the same time.
Yeah,
it's really you got to be opportunistic, because biotech is very binary, right? So clinical trial, usually fails or succeeds, and so each time you have opportunities to, if you good data, that's your opportunity. You got to take advantage of that when you can. So you got to get to that point, and so
So for example, Dipexium Pharma, my last company that we started, I had the number 2 guy, number 3 guy, some high guy at Valiant, now part of Bausch & Lomb, or Bausch, whatever it is. He was down in my little bombshell office down on Wall Street, and we were trying to sell Dipexium before we did the IPO. That was plan A. IPO was plan B. And when he heard the range that the bankers were taking us out at, he said, look, since you don't have phase 2 data, you're went from phase 1 to phase 3, you got to take that deal. We're not going to be able to get close to that. And I was appreciative that he was very honest with us, but, the idea is, if we didn't have a plan B in place, we couldn't have, said goodbye, called our banker and said, okay, let's go.
Yeah. There's nothing about entrepreneurship that's linear, and they shouldn't think that the financing will be linear too. Is that what you're saying?
Oh, yeah, yeah, you gotta, like Jeff said, every opportunity that you could think of that would be helpful to you, you want to keep it all moving at the same time until something comes to fruition, and then you have to make a hard decision and you analyze it as best you can. But as Jeff says, you leaning toward getting deals done. You know what I mean? Like, like there's nobody that did an IPO or any kind of financing this summer that now wishes, they got a higher price per share, less dilution. Now everybody's looking ahead saying, holy cow, a lot of people are saying we might be down 20% from here.
Yeah.
And then, you have to ask yourself, what happens? I mean, our strategic petroleum reserves are at a 40-year low. We're going to have to replace that oil at some point. And what kind of inflation is going to be caused by that?
Right. Well, luckily we don't have to solve that issue this morning. But let's talk about the issue of, we've talked about M&A and we've talked about large pharma. How are large pharma companies approaching their, sort of their pipeline of either in licensing, acquisitions? What are they looking for these days? Jeff, I'll start with you.
Looking for the same things: quality, promising technologies that can be integrated into their companies or work with their other drug products. So I think that's still quality. It's still, and even in this tough market, really good quality companies, they're still able to raise money. At lower valuations, but they're still raising money, and they still will attract big pharma and likely have more big pharma interest because valuations are so low. And so, what seemed like a pipe dream to acquire them, a couple of years ago, now, could be a great opportunity. So I think you're seeing definitely the M&A interest has improved dramatically over the last 6 months or year. You see a lot of, we're seeing a lot of diligence being done on different drug development programs. And we're starting to see more deals, and so I think that's going to continue. And so you need to be ready for it, for companies who are looking to be acquired, or that's one of a potential exit. You got to be ready for getting acquired. There's, get your diligence data rooms all together, and have all your books and records all intact and in good shape, because if big companies coming in, they want to see things being very professionally done, look good, and not be scattershot, and not include the stuff that should be there, and the legal documents need to be buttoned up. Make sure your intellectual property and your rights are tight. So there's things to do to be prepared for a potential acquirer coming in and looking at your company.
Wait, are you telling me as a lawyer that the legal documents need to be buttoned up?
Yeah, exactly. And these companies will find stuff that, this maybe, you don't have the rights that you think you have. So having good IP lawyers, is very important in the M&A process and in the going public process, as a life science company.
Yeah, to that, I think I would add, 15 years ago, 2/3 of the prescription drugs came from incubator companies, and 1/3 were homegrown big pharma. And now I think it's up to about 80%. But having said that, when you sit in a boardroom and you're going through your 200 slide deck, like I remember doing it once in London at UBS when I was with BioEnvision, and we were with UCB, I think. And we're going through the deck, and the science guys on the other side of the table, it's just human. There's a general reluctance to get involved. People are like, who are these knuckleheads, and why do we got to take their headache off of their hands? We know what we have. We're developing things that we know are wonderful, and there's a general human reluctance, and you have to break down that wall.
David, talk to us specifically about, like, when you're thinking about deals, because you've done a number of them, for your own companies. How do you think about approaching, like, the timing of a deal? Like, how do you think about, and like the runway towards, say, commercialization, right? Because I think traditionally we think about developing an asset. If you're going to partner, you'll maybe partner for commercialization with a company that has a established sales force, whether it's territorial or not, versus sort of building out the full complement of a larger company.
Yep. So following the logic of what we've already talked about, you throw everything at the wall at the same time. So like we did at Ipexium, as the phase 3 was winding down, we had a full commercial plan. It was ready to be implemented with the top people already selected through the board process, contracts, camera ready to go. And at the same time, we were working aggressively to try to sell the company. So you kind of do both things hand in hand, in parallel. And, we would do the same. There was an interesting, and this is just for pharmaceuticals, but there was a research analyst at Cowen who years ago, maybe 5-10 years ago, did an analysis over, I don't know how many years, long period of time. And his conclusion was that, pharma companies, incubator companies, that do M&A, generally speaking, they get sold a year or more before their FDA approval, or a year or more after their FDA approval, which made sense to me, because either the big pharma is going to want to, kind of buy the thing after it's been de-risked with clinical data, no later than at the time you're ready to start preparing the filing for approval. Or if they don't get it by then and they don't control the NDA submission, they're generally being, it being done by a bunch of knucklehead incubator company guys. Then they want to wait the first year to see 4 quarterly cycles to see how the marketing launch goes.
Right.
Because they figure, why take the risk? They're whatever they submitted for their NDA, we can't change that. So at this point, let's see how they do.
Right. So if they don't control the go-to-market strategy, then they'll wait, see how that works out, because that may impact, if they're still interested, what that valuation is.
Yeah, I mean, a lot of market launches, don't go, as Jeff would probably be able to say, people, have great plans. They don't go as well as you'd think. And then immediately, R&D stage companies are based, Wall Street puts us psychologically on the hope model, they call it. But then as soon as you have your FDA approval, there's no turning back. The next day, you're now on a bricks and mortar model. Your analysts remodel your company. When are the revenue streams going to start coming? What are first year, second year, third year sales going to look like? Tell me about the, sales and marketing team. What's that buildup going to look like? Then you're not on the hope model anymore. Now you're on the bricks and mortar model.
Yeah.
That's a good point. And the valuations tend to be higher on the hope model.
Exactly right.
When it becomes real, and we actually got to make money. And
look, I'm an M&A lawyer. I tell folks, Jeff, we don't want to reinvent ourselves as Johnson & Johnson. We want to do well for public health, for patients who have a life-threatening, disease. And, if we can get out of Dodge and let Big Pharma make more of the money and let our shareholders do very well, we're quite pleased.
That's right. And I think I think a lot of our clients kind of have that viewpoint, especially because it also takes so much money to market and commercialize a product. And so the limited amount of funding usually, to get to that point. So we're seeing a lot of our companies have that same viewpoint that David pointed out.
That's actually a great point that Jeff just raised, because if you put your drug in the hands of the big pharma company with an established, international sales force, and you have back end economics on the deal, the size of the pie might be so much bigger that your small wedge is worth more than you could have gotten yourself on your own.
Yeah. And they have a structure to go into physicians' offices and hospitals and help create a market for the product once it's approved.
Yep. Agreed.
Yeah. That makes a lot of sense. Let's talk about sort of, we've talked about markets, we've talked about valuations. Let's talk a little bit about sort of deals and terms that you're seeing. Jeff, are you seeing terms differently? And I know we've talked about different types, right, of fundraising and deals, but what are how has this market changed the terms of deals that your clients are seeing, sort of generally?
Yeah, so I'm primarily, in the public markets, capital markets. So, you're seeing, more warrants involved with deals. The deals that are getting done, you're seeing some at a discount to market. Especially for smaller companies, you have to navigate certain sort of complicated rules, either the baby shelf rules for S3 takedown offerings and the NASDAQ or New York Stock Exchange 20% private placement rules. So there's a lot of navigating, at the market and how much you can raise, and there are limitations on how much you can raise. And so there's a lot of deal structuring and lawyering, but very important lawyering, not just, arguing over stuff that's not important, but structuring deals in a way that comply with the rules and work around any limitations that the various regulators have put on the size of a deal and the pricing of a deal. So you're seeing, kind of being creative. You're also seeing, as kind of we talked about before, some deals where you have upside protection, to bridge the gap on valuations.
Yeah, I can say firsthand that I was just going to say, I can say firsthand that Mint spends absolutely no time on things that don't matter. It's just a delightful experience to watch them work.
Thank you, David.
That's it. We should clip that out, and then they can use it in marketing.
We should have clients as good as David.
See, exactly. It's a mutual admiration society around here this morning.
Yeah. Exactly.
What about, so Jeff, have you had companies, and we talked about David is a fan of throwing everything against the wall. I am too. But have you had companies do that? And then how do they decide which path to choose if they're presented with viable options for, is it walking away from the deal? Is it continuing with the deal? Is it accessing the public markets? What are sort of the factors that guide that ultimate decision on which path to pick at the right time?
Yeah, well, very difficult decisions because no one can really predict the future. So, so we see companies, a lot of it depends on how much money you have to get to your next inflection point. So if you don't have the money to get there, then you're going to have to be a little more receptive to doing alternative transactions. Maybe looking at getting acquired earlier than you maybe would have otherwise, because realistically, you may not have the money to get to your next point. So you may have to look in the mirror and take a deal that you maybe wouldn't have taken 6 months ago. So boards need to be open to more types of transactions, more types of financings than they would have been in an up market. I think, especially for entrepreneurs or for people who have not been involved in industry and finance really for many years, up to the recent point, had not seen kind of what could happen on the downside where interest rates go up and the markets tank. There was kind of, for a number of years there, incrementally, you do your deal, get more money, higher valuation, just kind of linearly do it. And now, as we have seen in other bubbles, but things turn and can turn very quickly. And so now you got to be more nimble. You got to be more receptive to different types of transactions, and potentially being acquired earlier, because the IPO market is mostly shut. Yeah. And so it's not a way to exit, go public these days right now.
David, what are you seeing in your counterparts, in the sort of antibiotic, antimicrobial space?
I think there's that bifurcation between, companies that treat mild infections versus those that are treating serious and life-threatening infections. For the latter, like Accurex, I think you're starting to see some pretty major movement from Roche that did the Forge Therapeutics deal. Then there's been a lot of GSK acquisitions. One of which Spiro we just went through the economics of. Pfizer's been buying stuff up, and there's Merck that's very active in the space. Remember, Shearing Plow is now part of Merck. If you were to go to the AMR actionfund.com website and look at the investors in the AMR Action Fund, that's the antimicrobial action fund that is made up of big pharma investors. There's about 22, 24 of them. Those are all the big pharma companies that have turned to antibiotics now and are interested in making acquisitions. But to Jeff's point, I think you're going to see in our space, at least with antibiotics, they're going to be targeted, kind of structured transactions, and you're going to get less. You're going to get less in this market than you would have gotten in an up market. And you're going to take it and say thank you, because the markets are so volatile right now that it really elevates the risk for incubator companies, which makes it an opportunity for big pharma. And it's an opportunity for the incubator too, because maybe you're getting less money, but you're getting your deal closed sooner.
Yeah. Did you say it was amractionfund.org or .com? I was going to put it.
Oh, you're right. It's .org. I said .com.
Okay. I'm going to put it in the chat for everybody if they want to take a look. So along those lines, right? So Jeff, have you ever had to convince, and David, have you ever had to convince Jeff, a client, David, your board, to take a deal in order to get to the next milestone when you didn't see a path forward otherwise?
Yeah, absolutely. We've had to counsel clients, and almost like a psychologist. You have to change your
lawyer.
Yeah, therapist. You have to change your expectations. Whereas a year or two ago, you had totally different views on your company and how you're gonna grow. You're gonna have to accept a different reality now. And so it's maybe not what you anticipated a year ago, but you just got to be nimble, and you got to still focus on what you're trying to do, which is usually developing a life-saving or a drug that will improve people's lives. And so if you focus on that, don't get wrapped up in day-to-day stock prices and what's going on in the market, and the stock went down today, and how do we get the stock back up? Just keep an eye on what you're trying to do, having enough money to get to that point, and things tend to work out better if you're focusing on those long-term goals, and don't get sucked down the trap of day-to-day how much our company is worth, because that's outside of your control. As we're finding, that is really outside of your control. What you can control is doing good work, developing your drug, getting to data, and then hopefully moving on to the next phase and commercialization. And if things work out great, you're going to get acquired, you can go public. If good data will tend to rise and get you to where you want to go.
Yeah. So for me, I guess I would kind of recast the question a little bit. We haven't, as many experiences as I've been involved with, we haven't been in that gun to your head scenario where there's either this deal or no pathway forward.
Right.
So usually, like in my experiences, the banker leads the discussion with the board, and you could say, is the current deal better than, a scenario of possible outcomes if we don't do the current deal? Is the scenario of possible outcomes if we don't do this deal better or worse than this deal? And if more of them are worse or much worse, then you kind of know what you got to do. but it does remind me of the old cell therapeutics thing. You know, I don't know if you remember cell therapeutics in the 90s, early 2000s. They used to develop drugs, they'd hawk them and raise money. They fail. And one day you'd see a new press release, and we're not working on this anymore. We're in license these 3 new drugs, and they're really good, and raise money. They fail. New slate of drugs, and they did that for I don't know how many years. But you know, those sorts of things are, you know, some people just don't want to take a deal. They just want to run a company, and you know, we're not all about that. When our phase 3 failed at Dipexium, 3 months later, we had a merger agreement signed for something new. We could have liquidated the company. We could have gone out and licensed something new. But we were trying to do what was best for shareholders.
Yeah, absolutely. We've only got about 5 minutes left. So let's shift a little bit and talk about what I hopefully will be slightly more upbeat than some of the things we talked about. Is talk to us about New York as a, you know, sort of life science biotech ecosystem. David, obviously your company is in New York. You've had other companies in New York. Talk to us about sort of the evolution you've seen.
Yeah, I mean, look, I think there's a number of biotech, biopharma companies in New York, early stage, you know, mid-sized, even Pfizer, of course. But you know, we're in Staten Island. I don't know who's listening, but I'd be curious to know if we're the first pharmaceutical company to be domiciled in Staten Island. You know, I certainly don't know anyone else in Staten Island that's involved with drugs other than illegal drugs. So I tell my wife all the time, I'm the only guy in Staten Island working on legal drugs. But it's a nice environment. You know, New York is great. It's very vibrant, you know. But you know, we can really work from anywhere. We're not the size of a company that can get, you know, kind of tremendous perks from the city or state. But you know, being in New York, you're close to investors, you're close to a lot of folks who may want to, you know, kind of do a partnering or M&A deal. And, you know, that's always nice.
Yeah, and I can add, I think the good thing about being in New York and being in the biotech community is that, well, it's a community, right? So it's a lot of like-minded people who've gotten into the industry. They want to do good. They want to improve people's lives. They want to save lives. And so for the scientists and entrepreneurs and lawyers who, you know, specialize in this industry, the focus is usually on making people's lives better. And so I think, you know, by tapping into that community and working together to achieve better outcomes for people and humankind, I think it's you know, loftier goals than just making money and, you know, pushing paper and, you know, moving on to the next drug and, you know, see how much money we can make there. I think, you know, we're really, all of us are trying to improve people's lives, and I think we gotta focus on that. And you know, I think people will be happier.
Yeah, you know, as far as I've been at New York Bio for, I guess, a little over 4 years, and the growth in the industry that's been here within New York and really the metro region, right, has been tremendous. And I think that's supported, you know, in large part by, you know, what David was saying. You have a lot of pharma companies here. You have the hub of finance here, but we also I don't think we can ever discount our academic medical centers and the ability, right, that they have to turn out PhDs and students that want to do research, want to start companies, want to be entrepreneurs, and want to do it here, which as New York Bio, we're grateful for. And David, you do get the award for the first New York Bio Virtual Breakfast Series guest from Staten Island. Yay! That is your Tuesday award.
Excellent.
And,
Thank you.
We're happy. We're so happy to have companies on Staten Island. Maybe there will be more than one legitimate pharmaceutical company.
Well, thank you for the opportunity, and nice to talk with you guys, and look forward to the next call and listening in.
Great. Thank you so much. Thank you both. This was great. I know folks learned a lot. So we will say goodbye, and we'll see everyone next Tuesday. Thanks so much.
Thank you, Jennifer. Appreciate it.